I mean, looking at what the Fed did now, given what the markets did today, just seems all the more pressing somehow. You know, Rich Clarida, the former Fed vice chair, you know him well, said today that the Fed is going to have to get that key rate far above neutral, something like at least 3.5%, if they want to start getting inflation under control. Is he right? Is the Fed behind the curve? Do they need to raise rates more aggressively?
Well, they're a little bit behind the curve for sure. I think last year the calculation was that inflation would abate, and there were, of course, COVID concerns at the same time. They made judgments in real time, and that they missed it a little bit, and they're now catching up. Having said that, I think we just have to watch how this economy evolves, and we're already seeing some signs of the labor market that's slowing a bit, so that could take some of the edge off of wage increases, which would have beneficial effect on the inflation numbers. So it's a wait and see situation as far as I'm concerned.
Was it a mistake for Chair Powell to so explicitly and definitively, at least for now, to say 75 basis point rate hikes are not even under consideration?
Well, you know, the word panic, the word emergency, those words, I think, apply to using a 75 basis point move and on its fundamentals. And I think Chair Powell very much emphasized this yesterday. On its fundamentals, the economy is actually pretty strong. The one negative, of course, is in inflation, but employment is strong, consumer activity is strong, consumer balance sheets are strong. So it's not a situation that calls for an emergency type of move, and I think he very clearly took 75 basis points off the table.
And yet, our colleague earlier was telling us that the Fed may be targeting to tamp down inflation when inflation is a story that you really don't have that much control because it's coming from other factors like oil, food prices, the war in Ukraine. What happens when you also have, as you mentioned, a very strong labor market and faster wage growth?
Well, you know, the Fed, the committee, is walking a very narrow path, trying to avoid a true recession, a severe kind of downturn, but at the same time trying to engineer a slowdown that does not put a big dent in employment. That's a very, you know, a very challenging path to engineer, and we'll see if they are able to do it. But the underlying employment situation remains very strong. The ratio of openings to the unemployed is at an unprecedented ratio, so almost 2 to 1. That was emphasized strongly by Powell in the press conference yesterday. They really have a lot of positives to work off of to try to bring inflation down.
Is today more of the reaction that the Fed chair would have been hoping for? Because the kind of knee-jerk reaction from the markets yesterday to no 75, that would have been a little bit worrying.
Well, I'm not sure Chair Powell or the members of the committee hope for any particular outcome in the equity markets, particularly, other than they watch equity markets for impact on the real economy, on the broad Main Street economy, if you will. And otherwise, I think there's an attitude that markets are going to do whatever markets do, and there's not much the Fed can do about that. I have heard the view, and I think there's some legitimacy in the view that some of the downturn in the market actually is like a reverse wealth effect. And in that sense, it may actually help the whole process of damping down inflation, slowing the economy, but not creating a recession.
You know, Dennis, one of our Bloomberg charts of the day is looking at the spread between the Fed funds rate and the consumer price index. It's the widest it's ever been, leading a lot of people to say, well, how could 2.5% on neutral? I know Jay Powell said he'll go above it if he has to, the Fed will, or 3.5% enough to start slowing inflation when you have this very, very big gap, this very negative, apparently not very tightening impact from the Fed funds rate at this point until potentially you push it a lot higher.
Well, I don't think there's any question, Kathleen, that there is a long way to go before you actually see the interest rate bite in the sense of actually being above whatever is the estimate of neutral. And one of the things he emphasized yesterday, and I think is very true, it's almost a theoretical concept. There are a lot of different economists with different views of what constitutes neutral, and neutral is at the same time a moving target. So it could very well be that the Fed funds rate has to get to 3 or 3.5% before it's at or above neutral. We just don't know. Also, the spread, there are many, many measures of inflation, and there are some somewhat encouraging signs. If you look at core inflation, excluding all the impact of energy and food, it's been flat for the last couple of months. There's a view out there that maybe inflation is peaking. So I always viewed inflation as not one number or one spread.
You know, Dennis, I spoke to another former Fed official today who I did not ask if I could quote, so I cannot quote this person now. But the argument was made that, you know, the balance sheet runoff isn't getting a lot of attention right now. But in 3 months, it's going to be nearly $100 billion a month. And that this is going to remove liquidity much more quickly, you know, risk premiums, real rates of return. This is going to make a big difference. You, in the past, have had jobs where you were in banking. You've advised small and medium-sized businesses. The person was suggesting that this is potentially going to be a very big hit to the economy, or excuse me, to markets. And the Fed is saying it's such a secondary tool. Well, maybe it's more primary than the Fed is thinking.
Could be. Powell is emphasizing that the primary tool of monetary policy is interest rates, and I think they very much want to put the reduction in the balance sheet in the background and have it run more or less on autopilot. Having said that, a $9 trillion balance sheet provides liquidity far in excess of many needs in the market. And they will go a long way in reducing the balance sheet before I think liquidity is going to really feel tight to the market. So this is maybe overreacting a bit to the beginning of the balance sheet reduction. We're going to be in a situation of high liquidity, considerable liquidity for quite some time.
Dennis, is there a sense that the Fed is now looking at labour market indicators as standalone indicators, as opposed to looking at how they merely feed into indicators of inflation?
Well, there is always a focus on employment per se, because that is half of the mandate, the dual mandate of the Fed. The situation now, of course, is that the employment situation is feeding inflation, so they're linked, and they're linked in a kind of a negative way. I think they're watching employment because they have to try to deliver full or maximum employment, but at the same time recognizing that rising wages are a potential fuel for continuing inflation. They're watching both.